Nearly 8 drivers have fallen in place for an Indian recovery ahead. What are these drivers? Let's walk through these 8 key factors driving this momentum in 2025. Number 1, income tax cuts. The February 2025 Union Budget introduced income tax cuts, increasing disposable income and supporting household consumption. Number 2, RBI rate and CRR cuts. The RBI has cut policy rates by 100 basis points, along with 100 basis points reduction in the cash reserve ratio, or the CRR. This has lowered borrowing costs and improved credit availability. Number 3, risk weight adjustments. Risk weights on bank loans, on NBFCs and MFIs have been reduced, encouraging more and more flow of credit to these very sectors. Remember, increase in risk weights in late 2023 led to an appreciable drop in credit growth. Number 4, liquidity measures. Liquidity was eased significantly through foreign exchange swaps and large-scale open market operations. This helped stabilize financial markets, lower call rates, and short-term yields. As and when the government starts spending money through FY26, system liquidity would increase even further. Number 5, inflation trends. Retail inflation has dropped by 210 basis points and rural inflation by 280 basis points, largely on the back of an appreciable drop in food inflation. Number 6, rural wage growth. Helped by a drop in rural inflation, real rural wages have grown sharply this year and are likely to move even higher, helping support consumption in rural India alongside good monsoons. Number 7, crude oil prices. Despite recent tensions in the Middle East, crude oil prices still remain lower from where they started early 2025, easing pressures on raw material costs of Indian corporations and easing India's import bill. Number 8, the Eighth Pay Commission. The Eighth Pay Commission is gradually being factored in, and once this sets in motion, it would greatly help structurally support consumption into the years ahead. Into the quarters ahead, consumption appears to clearly stand out as an incremental driver over that of investment on a relative basis. Does this mean the capex is out? Certainly not. With corporate leverage at decadal lows and a policy push towards self-sufficiency and localization, the focus on private capex would still remain. India's consumption story might be turning a corner, and here is why markets are watching this very closely. Urban consumption has been weak in recent quarters. Urban weakness can be seen in the corporate wage growth drop to 4.6% year-on-year for the March quarter, from 22% seen in the March quarter of 2023. The government's tax cuts from February of 2025 are probably underway, and the RBI's short and sizable 100 basis points of rate cuts would increase demand for credit. Now remember that tax cuts plus rate cuts bode quite well for an urban consumption revival. Now moving to rural India, monsoons seem much better than expected. Rural inflation seems to have seen a sharp drop in recent months, and this has appreciably increased real rural wages. Monsoons apart, the next few years would see a gradual but steady positive sentiment once the Eighth Pay Commission recommendations are announced, which would probably be sometime next year. The festive season is just a quarter away, and that's typically when spending picks up. The timing of all of this appears quite promising for India's consumption revival. The RBI's ongoing rate cut cycle would see a much faster pace of rate transmission this time around. Why? Let's break this down quickly. Indian banks lend money in two ways: fixed rate loans and floating rate loans. Broad estimates and loan books of top scheduled commercial banks have seen the loan book mix for fixed rate loans broadly unchanged and range bound at, let's say, 20 to 25%. Now that leaves us with the balance 75 to 80%. This 75 to 80% are loans that are based on floating interest rates. Now comes the main part. As of now, just above 60% of banks' outstanding floating rate rupee loans are now linked to something called the external benchmark-based lending rate, that is EBLR for short. Now, this is a big change from the last RBI rate cycle and would greatly help towards faster RBI policy rate transmission through the system. Why? Let's get introduced to another benchmark rate called the MCLR, which is the marginal cost of funds based lending rate. Now, this MCLR is an internal benchmark determined by individual banks and is based on their own cost of funds. This is less transparent than the EBLR and has taken much longer for banks in the past to pass on RBI's rate changes to banks' lending rates. The EBLR, on the other hand, is an external benchmark linked directly to the RBI's repo rate, which is more transparent and is most sensitive to repo rate changes. Further, banks must reset the EBLR linked loans at least once every 3 months. The EBLR system that was started in 2019 started with, let's say, under 3% of floating rate loans then, and now have more than 60% under EBLR regime today. So RBI rate cuts will now land up in lower EMIs much sooner than what happened during the last RBI rate cut cycle. While lower rates would impact most segments through competition, research indicates a probable increase in sensitivity of EBLR to retail, MSME, trade, and large industry loans. Even after a big bang RBI policy, why have 10-year yields in India risen? India's 10-year bond yields opened this week at 6.29%, and as we record this, yields are trading at 6.35%, nearly 10 basis points above where it stood on Thursday, the 5th of June, just one day ahead of the big bang RBI policy. Remember last week, RBI's policy delivered two significant surprises: 50 basis points repo rate cut and 100 basis points CRR cut, well above market expectations. Why have yields risen then when one should have expected that they drop? Let's break this down into 4 quick reasons. Reason number 1. RBI's repo cut has shrunk India's policy rate spread with that of the US Fed. It now stands at 100 basis points. Remember, India's is at 5.5% and the Federal Reserve's is at 4.5%. Now, this greatly reduces the structural rate support for the rupee. Reason number 2. On a fully hedged basis, after last week's RBI rate cut, FIIs mathematically might not make money in India debt. Why? With India 10-year at 6.35 now, as we record this, and the US 10-year at 4.45%, the spread the FIIs would make on this is roughly around 1.9%. Hedging the rupee for an FII costs around 2.1%, and so a 1.9 spread and a hedging cost of 2.1%, you're left with minus 0.2% spread, effectively a loss. Without doing any of this, the FII can just simply get 4.45% on the US 10-year yield with no forex risk whatsoever. And this, therefore, can be seen as greatly reducing the incentive for FII money flowing into debt, placing more pressure on FII equity flows and other forms of flows like ECBs, NRI deposits, etc. Reason number 3. The third RBI surprise in the policy was a change in stance. As the dust settled around the RBI's monetary policy, markets realized that the rate cut cycle was probably over for most of FY26. Reason number 4. Crude prices have moved higher to $67 per barrel from $60 a barrel seen just around a month ago. Markets broadly expect price stickiness due to expected short covering and trade-related uncertainties. So there you have it. These are probably the 4 key reasons why India 10-year yields are much higher than where they were before the RBI policy. We'll see you next time.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.